Welcome back. We begin this segment here in Nigeria with the fixed income markets, where the Treasury bill segment were upbeat as average yield contracted by 16 basis points to 17.69% on Thursday. However, at the bond segment, average yield expanded by 2 basis points to 16.56%. And for market wrap-up for the week, I'm being joined by a fixed income dealer at Diamond Bank, Wemisola Bello Aromire. Good afternoon, Wemi. How are you doing today?
I'm fine. Good afternoon, Chimeze. How are you?
Very well, thank you. Thank you for joining us. Now, wrap up the week for us. How much did the positive GDP numbers and PMI released this week drive the markets, the fixed income markets today?
Okay, resuming from the Salah break, market has been extremely bullish. Liquidity was high from the previous week, as we saw maturity the previous week of the bonds and bills desk help improve liquidity. Yields have contracted across both the Treasury bills and the bond segments, as we saw an upbeat movement from investors. So yields have contracted down on the bills and bond segments.
And what is the outlook for next week?
We're waiting for the auction calendar for the last quarter for the Treasury bills. That hasn't been released, but we expect people to go bullish on when the auction is released, or when the auction calendar comes out. We expect people to go bullish for that auction. We also expect next week to still remain bullish, as people are trying to pick yields that are attractive in the market. So we expect a bullish market next week, barring any major outflow from the system. That's when OMO auction is being done in the market. Bullish market next week is what we expect.
And in terms of liquidity for next week, what are your expectations?
Well, liquidity system industry average has not been released for today, but there's also retail option for the FX segment, which might mop up a bit of the liquidity in the system. So liquidity might not be high starting the week next week. So it might just be on the low, but the industry figure is not out today, so we're not too sure on that. But we still see a bullish market coming in the upper week.
All right, and for today, where do you see the market closing at?
On the Treasury bills, the short end was bearish, so yield on the short end expanded to 18% levels. And on the long end, which was bullish, yields contracted to 17.8 on the one-year bill. However, on the bond segment, we saw a bullish market too. We saw yields across the 2 years to the 20-year bond at the mid-16% levels on the bond segment of the market.
All right, thank you very much for your time. Wemisola Bello Aromire, fixed income dealer with Diamond Bank. The African Export-Import Bank is offering up to $300 million in depository receipts to private investors to boost capital for lending to industries on the continent. The depository receipts offer investors the same rights as normal shareholders, but issuing them does not come with the same regulatory requirements as issuance of normal shares. The bank's executive VP for governance and legal, George Elombi, says the fresh capital will help Afrexim Bank to secure further funds through borrowing to lend to investors who wish to process African commodities like cocoa growers in Ivory Coast. The Cairo-based Afrexim Bank, which focuses on boosting trade in and within Africa through financing, has assets of $12.46 billion, with $10.84 billion of that being loans. It is owned by a range of shareholders, including African governments and central banks. The depository receipts by Afrexim Bank, which are priced at $4.30 per unit with a minimum investment size of $300,000, are aimed at sophisticated investors like pension funds. And South African banks are reining in lending as President Jacob Zuma's administration struggles to reignite economic growth and revamp business confidence. currently at its lowest level since 1985. First Rand, Africa's largest lender by market value, reported net interest income growth of 7% for the 12 months through June, compared with an increase of 18% in 2016. Standard Bank, Barclays Africa Group, and Nedbank all published first-half results in August, showing a similar pattern. While earnings appears to be growing on cost containment and lower impairments, analysts see decline in growth. The four big banks are impacted by South Africa's political turmoil, leading the institutions to cut lending. In the meantime, ratings firms Moody's has warned that proposed plans by South Africa's government to implement radical economic transformation could turn away investors, and rising poverty may curb Treasury efforts to rein in fiscal deficits. Moody's says in a research report that plans for land redistribution, preferential procurement, and other forms of affirmative actions could deter investors. In June, Moody's downgraded South Africa's credit rating to Baa3, the bottom of the investment grade table, with a negative outlook, citing the abrupt sacking of Pravin Gordhan as finance minister in March. As Zimbabwean business leaders have warned President Robert Mugabe that his government's expanding fiscal deficit was unsustainable and that financing it through local borrowing could destabilize the banking sector. At the first such meeting in 10 years, executives from the mining, manufacturing, banking and farming sectors and representatives of foreign airlines told Mugabe and his cabinet ministers they must exercise fiscal discipline. Mugabe did not directly respond, but said there should be more meetings between his cabinet and business leaders. In July, Finance Minister Patrick Chinamasa said the budget deficit had risen to $1.4 billion in 2016, worse than previously estimated and equivalent to 10% of national output. Zimbabwe has not been able to borrow on international financial markets since 1999 after defaulting on repayments to the International Monetary Fund and other foreign lenders, and must rely on domestic taxes to fund its $4 billion budget. And that's the wrap on the program for today and, of course, for the week. Thank you very much for watching. I'm Chimeze Obi. Enjoy the week.